Good evening, it's Ken at Tortoise Capital. Back from our soccer match. The Mighty Thunder girls won 2-1. Excellent game. So, just to discuss this emerging use of the multi-time frame NDX summary, we've just started adding to the daily and weekend reports. So, this is some insights from a pro money manager. We're talking about things in the bronze time frame there, where we're looking at longer than swing trading, but shorter than buy and hold or just basic asset allocations. We're trying to get some of these position trades in. And this is his insights into how this might be used, because we know that the longer term you look, the more it's a relative strength kind of a game, that winners continue to be winners out to the 3-year time frame and beyond. And the sooner that you can hook into that long distance train ride, the better, and then just get pulled along by a powerful engine of value and then momentum. So this is a way that we're thinking about how this might be used. So the 270 period look back, which is a little over a year, might be relative strength step one, where you sort for where it is in its annual trading range, and the argument being that the closer to the top it is, then probably it's outperforming the peer groups because it's pushing near all-time or annual highs. And then maybe the 90 period look back, the 90-day look back might be where you have the equivalent of going from below average to above average, almost in the sense of a Darvis value box here, where it crosses from the spring into the summer, and that would be good. So that would be a score of 50 or better. The 30 period look back could be the equivalent of like a PSAR flip, which is how we look at time to initiate new positions when we're looking at MACD histogram and the RLCO framework. So these taken together could be like an unambiguous move, a MACD seasonal improvement, a PSAR tactical flip, and maybe a 10-period look back would be the equivalent of an owl. And these could all be sortable columns, and you could actually use the color codes and the location to find different places on the curve where you want to go. Like our good friend Robert Gardner used to love what he called the high fade. He liked to see things that were in the green on the longer term time frames that had pulled back into the white. So in this case, like IYR, real estate and utilities, as an idea that here you had something that was demonstrably outperforming, that had pulled back to the midpoint, like around 50 or 60, and then you might frame that for a continuation pattern or a pocket or a channeling. That was his favorite thing. I tend to be more of a catfish. I like things that are horrible long term that are getting slightly better. So in this case, something like XOP would appeal to me because it's been crushed on the 270 and the 90, but on the 30 period it's kind of moving up a little bit, and it's not the worst thing in the stack. So I might be looking at oil exploration and energy as a way to start framing some opportunities. Or you might simply look for things that were like XLY, consumer discretionary, or XLP, that have been brilliant long term and that have just gotten smashed on the 3-day and the 10-day look back. So that's not an orderly pullback. That's a sharp, adverse, short-term move. Maybe that's profit taking at a potential turning point. So that's either going to be a return to previous highs, or it was the cracking sound that is the breaking of the ice on the lake in the spring, and things are going to start breaking down, and it's a reversion back to the mean. So just the way this is sorted right now, with the 10-period look back being the controlling one, it makes a nice distinction between the things that are short-term swing trade outperforming versus the things that are not. And I want you to notice that in the red box here, this is predominated by things that have been doing very well over the last 270 and 90 days, and then suffered a short-term pullback. So that would be like buying quality or buying longer-term momentum on the first break or the first dip. The green box on both sides of the stack here are things that have been generally dominating long-term, but are still dominating short-term. So this is like the more urgent upward momentum and probably in the last 5 or 10 days, these have done really, really well, whereas these are really, really pulled back. But in both cases, they have long-term relative strength. The things in the soft middle are, you notice, these are the ones that have been underperforming more often than not on the long term, but also have been getting smashed. So there's no real compelling reason for people to want to hurry up and buy this or to hurry up and short it, although if anything, hurry up and short is probably a better posture because it's already weak long term. So like metals and mining, it wouldn't take much additional weakness for this to really continue to suffer. It's only had the 30-day look back where the metals and mining have done really well. Otherwise, it's been consistently underperforming. So this is a way that we might use these different look back periods and the simple technique of the NDX to start identifying things like on a heat map basis that might allow for swing trading or longer, depending on what kind of position you want to try to build. And then there's an opportunity to do different parts of the curve that are aligned with your strategy or your personal preferences. So if I were now to just kind of zoom in on the ETF table, as you'll notice, I have this sorted by the 10 period. If I just wanted to look, say maybe at the long term and segregate by that, I might do this. And so metals and mining, energy, you see, have just been horrible. Then all the things that have been closer to the top of their stack. Notice the prevalence of all the U.S. leaders right here. The S&P, diamonds, tech, gold, and then the soft middle, the international indices, and lagging way behind emerging markets, Mexico and Latin America. And so this might lead me to, if I want to take a look at where they were in the long-term stack or the 90-term stack, I just like the 10 period because I start with the swing trade opportunities and try to build out from there. So when I sort that this way, we get the table that as it appears inside the weekend report and the daily report. But this is relatively easy to construct, and the math is pretty straightforward. So this is a nice tool, easy enough to do in TC2000 TradeStation. Anybody that has any kind of analytics, this is the power of the NDX and the look back period, in understanding that from extreme conditions come extreme results. So that's what I wanted to talk about, and thank you for your kind attention.